All right, everyone. I want to welcome you to the October State of the Market Economic Update. We've had a lot of things happening this month, and there's actually, for probably the first time in a few months, there's some good news. So I'm excited to share some of that with you. As always, we do these updates so that you have an opportunity to understand some of the economic data that affects you in your business and your clients. And as it relates to this information, I don't expect you to become an economist. I pour over the data, I study the trends, I watch the markets closely, and this is an opportunity for me to provide you with some interpretation. And while I say that, like I say, I don't expect you to become an economist, but I do hope that as you hear some of the economic numbers in the headlines, as you read the news, that you start to pick up on a few of the nuggets. So while we keep it milk and cookies, I want you to be able to understand how to connect some dots. And in the MREA, Gary talks about becoming the local economist of choice. And this is about understanding your market. And in fact, I shared this on the last call. The new rookie real estate agent book is out. This is the sort of the prequel to the MREA. And in here, he talks about 6 economic trends that you need to track. And we ironically cover all 6 of those in this call. So with that said, we will get started. If you guys have questions, don't hesitate to put that in the chat or raise your hand. Any participation is welcome, and Miss Kennedy is monitoring the chat, and she'll let us know if there's something that we need to touch on. So with that said, let me dive into where we are today. So it's October 2025. Click over here. There we go. I, of course, Brian Wentz, the OP for KW Coastal Living and KW Coastal Living 2. My 2 compadres, Chris and Josh with Echelon Home Loans, they're instrumental in helping to develop this content. And of course, behind the scenes, the 3 of us look like 3 schoolgirls with a constant text thread going on all things economic. So yes, we're the geeks so that you don't have to be. Ironically, Chris and Josh both are taking applications at the moment, and we're going to talk a little bit about the fact that mortgage applications and the pace of progress has taken a significant step forward. So there's some exciting developments. And with that said, as always, you have access to the Echelon IntroLend app, which allows you to fast track your clients. So if you do not have the Echelon app already installed, grab this. This is like giving out a business card to your buyers or your sellers that need either financing or refinancing options. And if you have any trouble being able to log in at all, just let us know. We will make sure, it's any member of the staff, and we'll make sure that you have access. This tool does allow you to fast track clients earlier and then allows you to stay very closely attuned to all of the communication that's going back and forth between the loan originator and your buyer or seller, so that you don't ever have to ask, hey, where are we at? What's going on? Additionally, there's some back-end tracking that just helps you be able to stay on top of the transaction. So grab those if you don't have those. And let's talk about what's happened in the last 30 days since our last call. So of course, yesterday was the Fed presser day. So the Fed had a meeting yesterday. So we were busy last night combing over the data, reading Jerome Powell's commentary, and kind of reading the tea leaves of what happened. So let's hit a couple of bullet points of what's happened. First of all, mortgage rates have fallen to their lowest level of the year. Now, yesterday's commentary kind of put a little bit of a wet blanket on that. So rates, for the 3rd time in a row, the Federal Reserve cut the federal funds overnight rate, and mortgage interest rates went up, which is not typically the case. In all 3 instances, it had to do with the fact that the Fed had commentary afterwards that was a little bit more hawkish or a little bit more careful, as opposed to a little bit more positive. So with that said, I'll walk through kind of what was said and how that impacts us. However, that said, rates are down substantially, and we're going to talk a lot about mortgage rates and what this change means for you and your customers today. Those lower rates are setting us up for a really, really good 2026. And as we look ahead, at probably the next 5 to 7 years, barring any like really odd set of circumstances, we're really getting prepared for a really, really good run in the real estate industry, which would be a little bit akin probably to the 2012 through 2018 run that we had, where we had 6 just incredible years in real estate. So for those of you guys that have been around, we've been in a housing depression, or I shouldn't say depression, we've been in a housing recession since June of 2022. So we've had 3.5 years of the lowest sales pace in US history. So I see this often. If it feels hard, it's because it has been hard the last 3.5 years. Now, with rates coming down, affordability is improving. So we're starting to see more optionality for your buyers. And we're starting to see buyers who could not qualify for homes a few months ago who now can qualify. The 10-year Treasury, we're going to talk a little bit about that. The 10-year directly impacts mortgage rates. And we'll talk a little bit about the slow dance of mortgage rates with the 10-year Treasury. But the important thing to note is for most of this year, the 10-year Treasury has been very reactive. In other words, something little happens and the rates move a lot. It's been interesting the last about 3 months. Things have been very calm and quiet. So while actually big things have happened, the rates have barely moved. And that's a sign that the bond traders are a little bit more, they're a little more comfortable with being able to see what's ahead. Now, one of the challenges we have right now is government shutdown is impacting key data. So there are several pieces of data that we track that we just don't have access to this month. And I'll show you what those are and what that might mean for the future. That lacking data also played into the Fed's commentary yesterday and is part of the reason that rates popped up just a little bit. Inflation cooled this month, but we still have a little bit of a concern. We're still running a little hot, so we're watching that closely. And of course, as I said earlier, the Fed did cut 25 basis points, which is a 0.25% cut of the federal funds rate yesterday. Now, that doesn't directly impact interest rates, but it does indirectly affect the bond market. But here's the catch. They made a cut, but then they hinted that there would be no cut in December. And the market was really counting on a cut this month and a cut in December. And in fact, the odds of a cut yesterday were, I believe, 96%, and the odds of a cut in December were 90%. And now I think we're down into the 40s for a December cut. So that could keep us a little bit higher in interest rates for a little longer than we want, but we're watching that closely. Over the last couple of months, the Fed did make a pivot from really focusing on inflation information to labor information. And the impact of that is that the Fed's been indicating for a while that it was labor over inflation, but because the labor market has started to soften, that gives us some indication that we could see further interest rate cuts ahead, and it just depends on a number of factors. One thing that's impacting that substantially right now is just the immigration policy. With less immigration, there are less new workers coming in. It's creating some worker shortages in a few key areas. And that's throwing off the way that we look at the data just a little bit. So there's some questions, and that's we'll hear that in Fed Powell's commentary. Mortgage purchase applications have been on the rise, so not surprising. Rates fell, applications went up, and yet it hasn't been as much of an increase as we would expect for how far rates have fallen. So that's an indicator that buyers are still feeling like rates are going to fall further, and yet they may not fall as fast as I think some buyers are expecting. And then lastly, we did see existing home sales start to take a turn. So we started to move into a little bit more positive territory. I said there's an asterisk on that, and I'll tell you why that is. So if we dive into 30-year mortgage rates, in October, rates fell to about 6 1/8. You actually could get rates better than 6 with some additional points, but you're looking at about 6 1/4. Now, yesterday with the decrease in the federal funds rate, but then the commentary afterwards, rates did go up to about 6.3, and they were about 6.375 when I looked today. The presser was a wet blanket, as I said, and here's why. Jerome Powell made this analogy, and he said that we don't know the impact of what tariffs are going to do to inflation. We also don't know what's happening in the job market without all of the job data this month. And so he asked the question, what do you do when you're driving in the fog? And his answer was, you slow down to avoid mistakes. And his point was that he wanted to make sure that he said that the chances of a December rate cut were kind of a little bit off the table. There was a lot of internal debates with all of the Fed presidents. However, with where they are, they just didn't have enough data to give very clear forward guidance. And so they're going to be in a wait and see approach. Now, that surprised the markets and it impacted the bond traders without question. His direct commentary was, he said, don't count on cuts in December. And the market had already priced in 2 cuts. So like always, the bond market tends to get ahead of what's happening. And that's why you don't always see the direct impact when the Fed cuts rates to mortgage rates. So let's just take a little bit of a look and see where have rates been over the last year. And this graph just shows you 12 months of rates. And as you can see, we had a high in January of a little over 7%. Now, by the way, that's still better than the nearly 8% that we saw in 2023. So we're down almost 2 points, and that's a huge story to tell. We did drop down to about 6.19 last week, and it was running into this week. So you can see we're down almost a full percentage point over where we were just at the beginning of the year. And that impacts affordability. Now, it's important when we see rates, especially for those of you who may be a little bit newer to the industry, we want to zoom out a little bit and look at what's happened historically. So if we look at this in a historical way, this is looking at the last 5 years. So this takes us to the end of our COVID period into today. This period, it represents the fastest increase in the federal funds rate dating back to the 1980s. And so you can see how quickly those rates rose since June of 2022 particularly, and the impact that that's had on housing. So again, with the increase in pricing and the increase in rates, this has just created an affordability issue that's put a cap on the market. So with that said, if we look at this from a very historical perspective, you still can see in this period right here, you can still see that represented a really fast increase in rates. And yet, when you look back to the 1980s, the early 1980s, when interest rates were almost 19%, we're still in a really good market. And I think that particularly those who have maybe been in the industry for just a few years, I think this slide just gives you a little bit of perspective, because even in 1981, homes were still selling. Sellers were paying 7-8 points to be able to buy interest rates down. It was a different negotiating environment. But there's never been a point in time when homes haven't sold. So the message is there's transactions out there happening that you yourself can go capture at this moment. And if we look at that long-term historical average since the 1970s, it's been about 8% has been the average. So when we start to talk about 6% interest rates, we're sitting 2% below the long-term average. We're still in a good market. And I think that message, I think it's important for us to be able to know that so that we can articulate the buyers. The days of a 2% mortgage, they're just gone. And we frankly hope we don't see that again, because that means that the economy has probably gone to heck in a handbasket, and that would be a problem. So if we look at today's mortgage rates, we're sitting at about 6.27. These are averages depending on credit score, how much someone puts down, depending on the origination fees. You can get lower than 6.27. This just gives you a little bit of idea on a 30-year fixed. 15 years are in the high fives. Jumbos, 6.2. You got some ARMs that are still in 5.9 territory. Not as competitive, frankly, as you would expect. FHAs, we've seen some FHAs in the high fives. So we're sitting at 6 today, and then VAs also at about 6%. So again, very competitive rates. Good time to be a buyer. Now here's a slide that is really good for you to commit to memory. I looked at what's the rate impact locally. We looked at the local, and I used Sarasota County for this, the local median sales price, and at 20% down for an average buyer, what was their principal and interest payment in January versus today? Back then, I have an @ sign that's supposed to be a $ sign. It was 2,448 in January. Today it's 2,194. That's a savings of $254 a month. So for the average buyer, their affordability, either they saved over $250 a month, that's over $3,000 a year. The life of the loan, that is going to be $92,000. So that's about a 10.4% savings. But here's the key: that gives your buyers an additional purchasing power, not including taxes and insurance, the other thing, but just principal and interest only, about another 50 grand of purchasing power. So you got a little over 11% more purchasing power. That's an important note for your sellers and an important note for your buyers, because you may have buyers that couldn't afford the house, a listing a few months back, that now can. You may have buyers that couldn't quite find the house they wanted, and they can eke into that next price point, which may give them an extra bedroom, an extra garage, a pool, something that they couldn't find a few months ago that now they can. So keep that in mind. That's a slide to kind of hold on to. We have some talking points here for buyers. A great script, as you've probably heard, rates have started to come down, and that's a big deal for buyers. Even a small drop in mortgage rates can have a huge impact on what you can afford. With the current rate drop this year, the average buyer gains 10% more purchasing power or saves a couple $100 a month on the same home. This means the same budget now stretches further. Maybe you can afford that extra bedroom, the pool, or a better location without even increasing your monthly payments. And here's the key: when rates drop, more buyers will jump in and competition goes up. So getting in now ahead of that curve puts you in the driver's seat before prices adjust upward. And the reality is, as those rates start to be hitting those low fives, we know that from experience, anywhere from 10 to 14 weeks of rates in that 6 to 6.4 range historically spurs activity, and we will see existing home sale growth. So it's a good time to get in ahead of that, because as more buyers into the market, you get back to a little bit more competitive multi-offer situations. It's just a good time to be a buyer in this market. For sellers, this is a script you can use. You've probably seen the headlines: mortgage rates have started to come down. It's great news for buyers, but it's just as important for a seller. When rates drop, affordability improves, which means more qualified buyers can afford your home. With rates down, a buyer's purchasing power is up by about 10%. So if your home is listed at $500,000, that same buyer who couldn't afford it a few months ago may now comfortably afford it. And when more buyers can afford your home, that usually means faster offers, stronger demand, and better negotiation power for you, the seller. So in short, lower rates brings energy back into the market. There's a great window to take advantage of that momentum. So for people who may be saying, hey, I want to wait till after the beginning of the year, for people that may take a wait and see approach, this is a script on a seller that would help move them to a choice point. And interestingly, I'm going to point this out later, we're seeing some interesting trends in that there are increases happening in the sales pace in the fourth quarter that historically do not happen. And again, that's an indication that things are starting to accelerate. So I put this in here. This is courtesy of Chris at Echelon Home Loans, but this is the percentage of homeowners by interest rate. So we still have about 70% of U.S. mortgage borrowers have a rate under 5%. And this is where you hear them talk about a mortgage lock-in. So you'll notice at the bottom, the percentage of greater than 6%. These are people that have bought in that late 22, 23, 24, 25 timeframe. When you see 5 to 6%, you see that number growing substantially since 2020, really since the beginning of 2022. And of course, the sub 3%, you still have some people that are still locked into those very, very ultra low rates. And at some point, life events happen, and we're going to see probably over the next 12 months, I think we're going to see these numbers change very much. Or significantly, in that people that have to go through a divorce, they have children, they relocate, they are finally at a spot where we need that extra bedroom for an office, whatever that event is, we'll see those moves starting to come out, and the lifestyle moves are what changes this dynamic. Now, this was also an interesting one. Currently, 43% of all homeowners don't even have a mortgage. And this is a breakdown of U.S. homeowners mortgage by age group. So that I laughed that it's 15 to 34. I don't know what 15-year-old has a mortgage, but 15 to 34, 35 to 44, and you see the tranches as you go up. And of course, the retirees, when you get into 65 and up, it's a pretty significant percentage do not have a mortgage. And so the reality is that for a lot of the owners that are moving, they've got their equity is high. They've got the free cash flow to be able to make the move, and they're paying cash. And I know that we had an agent that was sharing that their last 5 transactions had all been cash transactions, both sale and purchase. So we're seeing a lot of those cash transactions out there. So that means mortgage rates does even impact that buyer or seller. If we look at where does this mean we're headed long term, the first half of 2026, just based on what we know now, we're expecting to see rates stay pretty steady in that 6-ish range. We may see some creep into the high 5s. We may see 6.25 bouncing in that range, but it's going to be in a channel somewhere in there. However, based on the job data, the inflation data, what we're seeing right now, as we start to get in the second half of 2026, it's looking like we're going to see those rates continue to fall down a little bit, and that's going to be driven by job growth, the slowing job growth, and it probably will include mortgage spreads getting a little bit better. So we're going to watch that very closely, but it's looking like 2026 is going to be not a record year, not a banner year, but it's going to be a lot better than the last 3.5 years have been. And of course, that assumes no economic surprises, which is things like war or terrorist attack or anything like that. Now, this brings us to the 10-year Treasury. And of course, the 10-year Treasury is the bond that is the benchmark for which mortgage rates are set. So the 10-year Treasury has been trading in a range of about 3.9 to about 4.2. That's a pretty tight range. And as you get into that 3.9, 3.8, that's a really key technical level, which means a lot of things have to happen to see it go below that range. But because we're bumping up against that, that's actually a really good sign for mortgages. Now, the key is the bond market was pricing in 2 cuts, 225 basis point cuts. So it'd be 2 quarter-point cuts, which would have been 0.5% for October and December. And there's a little bit of uncertainty in that. And I think that the key driver of what happens is going to be what we see in the labor market and the labor data. Now, Bureau of Labor Statistics is closed right now due to the government shutdown, so we just don't have any of that data to be able to work with. But we will show you some of the revisions that were made and the trends that we're looking at. So if you see, this is the 1-year 10-year Treasury note. Notice how prior to that October 1st, we had a lot of volatility high and a lot of volatility low. When we announced the tariffs on Liberation Day, the bond market reacted substantially. And so you can kind of see that drops, and I'll show you the slow dance between the bond market and interest rates here in a minute. But you'll notice here this last quarter, we've started to just kind of start to trade in a range. There's been the bond traders have been a lot less reactive, and that's part of the reason we're seeing mortgage rates kind of settle in, and we're not seeing those huge changes. Now, there's a direct correlation between the 10-year Treasury and 30-year rates. On average, you typically see about 1.7% increase, and this is what we call mortgage spreads. And it's important for you just to understand this at its fundamental level. So if you see the 10-year Treasury at 4, you're going to see interest rates on average historically at about 5.5 to 5.7, somewhere in that range. The challenge is the spreads have gotten very high. And in fact, in the 2023 timeframe, the spreads reached almost 3%, which is why we saw almost 8% interest rates on mortgages. And that indicated a lot of volatility and a lot of challenges that the bond traders couldn't see what was ahead. And that was particularly during really high inflationary times. But again, about 60 to 65% of a 30-year fixed rate move is the 10-year Treasury. The rest of it is Fed policy and Fed commentary. So if we look at this, we call this the slow dance. This is the trend, and the gray line is actually the federal funds overnight rate. And you can see how quickly between 2022 and 2023, the Fed increased the federal funds rate. Now that did push the bond market up, as you can see, and yet you'll notice what we call the slow dance. This space between the red line, which is the 10-year treasury, and the blue line, which is 30-year interest rates. And you kind of see they just kind of sway together. Sometimes they're a little closer. That means the spreads are a little better. Sometimes they're a little further apart. That means the spreads are a little worse. But you can see how that correlation comes together. So if we look at this, currently, 10-year treasuries are running at a little over 4%. Your 30-year fix yesterday was 6.27, which means that spread's about 2.2. That means if the bond market could just have a little less volatility, if we had a little bit better forward guidance, and part of that, frankly, will probably be the announcement of a new Fed president, a new Fed chairman. Chairman Powell's his term is up in June, and if you followed anything, and if you've been on these past calls, he and Trump, he was appointed by Trump during Trump's first administration, and they have had a brouhaha that has been highly public and highly challenging. And if anything, Jerome Powell dug in his heels and said, make me cut or make my day. And as a result, he's been very stubborn in reducing. Now, they do have an important job to maintain their independence from the rest of the government. And we now are I believe we're the 16th highest interest rate in the world right now. Many other countries have cut much faster than we have. And that's just a bone of contention for the administration. So with normal spreads, we could see rates in the 5.5 to 5.8 even right now. So there's a little bit of market volatility in there. There's still prepayment risk because they know that as rates drop, those people that may have just taken mortgages may refi. And there's a little bit of lower demand for mortgage-backed securities. However, Fed Powell yesterday announced that they were going to end quantitative tightening, which all that means is that's going to mean there's going to be more demand for mortgage-backed securities, which will bring positive rates to the consumer. So I mentioned that quantitative tightening is going to end December 31st. That lower volatility, there's a lot of economists talking about this right now, but that could improve spreads another 20 to 30 basis points, which again could bring us even at current rates down to 6 to 5.9, which means with spreads improving even further, we could be at a 5.5% rate next year pretty easily. The biggest challenge is that tariff policy agreements still are leaving a question mark in terms of what's going to happen. And yet the president's been on a large worldwide tour this last week and put several trade agreements in place. So there's a little bit of clarity that's starting to show up on that. We're just unsure how that's going to affect inflation. And that's, of course, one of the two mandates of the Fed. Inflation and employment. So if we look at mortgage purchase applications, lower rates are bringing buyers back into the market. The last 8 weeks, we've had 4 pretty significant increases, and this is actually the second highest set of increases since March of 2020. And of course, that was the start of COVID when everyone figured out they were going to be stuck in their houses. They rushed out to buy a house, and mortgage rates were competitive, and the fury began if you were around then. So this chart shows the MBA's application index, which just shows the increase or decrease from week to week of mortgage purchase applications. This data is heavily impacted by things like holidays, key events happening, and then the increase or decrease in rates. But you can see in early September, we saw a 29% week over week from last year to this year increase. And then we were 7.4% up this last week. So things are headed in the right direction. The two big factors the Fed looks at is employment and inflation. And the Fed's dual mandate is to keep inflation as close to 2% as they can, while also keeping employment as close to maximum employment as they can, which means somewhere in that 4.5% unemployment rate. The BLS made some huge revisions, and the timing of this, again, there's been a lot of irony this year. The last 2 Fed meetings ago, the BLS data was released the day after. And because the revisions were lower, had that information been available the previous day, we probably would have seen a rate cut at a time that we did not see a rate cut. So we'll look at what this looks like, but there's a really fascinating thing that's happening, and that's with reduced immigration, with the border being virtually closed off. There are less workers coming in, and that is having an impact actually on how the unemployment numbers are showing up. That's creating a little bit of that fog that he said that Jerome Powell said, we're driving in fog and you just want to slow down and be careful. Now, the October jobs report was not available due to the shutdown, so that's kind of the question. But I want to show you this because this is important. So if we look at what the U.S. new non-farm payrolls look like, so these are the number of jobs that are added to the economy. You can see November, December last year, very strong. The beginning of this year, not bad. We saw a bump up in April, May, June. I believe the June number had a lot of federal teachers being hired at the federal level, school teachers being hired. And here's what happened. When we go to the next month, you see we had revisions down to where the economy added significantly fewer jobs. Now, this isn't a bait and switch number. It's just the way the BLS, the way they track their data and the way they do their surveys. It's a little bit of a hard thing to get businesses to be able to return the data. So when they finally get it in, they do backwards revisions. Then what happened is we revised again after July, and you can see what May, June, July, and August look like. Now, we don't have September numbers yet because the government is closed, but that revision gave pause to both the bond market and the Federal Reserve. And that's an indication that as jobs slow, if labor breaks, that could put us into a recession. So that's where the Fed just watches this very closely to make sure that we're straddling that line of not too much job growth where the economy overheats, which creates inflationary pressures, and not too little job growth, which slows the economy down and acts like a drag on the economy. So that takes us over to the second part of the dual mandate, and that's inflation. And I've talked about this before, but when we say the word inflation, we have to kind of know what inflation are we talking about? And there's a couple different metrics. So you have one that's the CPI, the Consumer Price Index. And this is a basket of goods that represents all the things a typical household buys in any given month. And it tracks the average price of all those changes month over month. And we'll look at what this looks like. CPI is really, when you hear US inflation rate, that's really what they're talking about. It's a basket of goods. But it does include food, energy, rent, cars. Food, energy, and rent can be very volatile. So we have a core CPI that takes the highly volatile things out, which is food and energy, and it shows the underlying trend of what's really happening. And the Fed watches that because the core CPI can be sticky. In other words, when that goes up, it doesn't come down. When potato chips at the store increase in price, they just never decrease. That's the reality. Then we have the Producer Price Index, which tracks what businesses pay for goods, and that impacts what gets passed along to us. So if we look at this, again, government's closed right now, so we don't have some of these data, although the administration, through a miraculous method, I can't imagine how this happened, but the CPI number was pretty good this month, and so the BLS did actually release this number. So the CPI was at 3%. We want to see inflation at 2%. So US inflation, things cost 3% more than they did last year. Now that's the highest since January of 2025, but only by 0.1%. It was 2.9 in January. This reflects that energy prices are up and food prices are down. The core CPI came in ironically at the exact same thing, 3%. And yet that includes still rent and shelter. And the way that they calculate this, there's a lag. The last 12 to 18 months, we've seen rents coming down, and we're going to eventually see that come into that core CPI number. And that means that probably will mitigate the inflation, the core inflation rate, which would be another target that would allow for further Fed cuts, assuming that job growth continues to wane as it has. The PPI was also down to 2.6. That was actually pretty good considering that we have some tariffs. That's a sign that a lot of the suppliers are taking the tariff hits at their end and not pricing along to the consumers. So that's a good thing. So if we look at this in terms of historical formats, you can see where the last year has been in terms of just inflation. You can see in April, we were down to a pretty low rate, very close to that too. And that's when we really thought things were going to be in a better place. The tariffs kicked in. We do see some inflation kicking in again from energy and tariffs predominantly. Now, this really tells a picture. Again, I show you this graph so that you understand the historical references on this, but the CPI, if you look at the post-COVID trend and how much things cost, you can just see how incredibly fast the cost of things went up. And we all feel that when we go to the grocery store and we pay more for a smaller thing, a smaller set of chips and everything across the board. And yet we're starting to kind of calm that process down. So that's a 10-year. If we look at the core CPI, taking energy and food out, you can see what's happened over the last couple of years. We've started to get back to a more relative or more historical pace. We're still high, but this right here, this is what's causing the Fed to have a pause because we still have a little bit of an upward trend. And that's where the fog sets in of employment and inflation. They're going, hey, let's just drive slower and make sure that we don't drive off the road. Unemployment, this is just what percentage of the labor force is unemployed. This was at 4.3% last month, still low by historical standards. We don't have this data available, but again, you can kind of see the trend of where since 2023, where unemployment has continued to rise. This was a very, very low number, and this is part of the reason why they were increasing rates at the time. And yet, if that trend continues and we see employment starting to increase or worse break, that would mean that would be something that would trigger the Fed to really get aggressive and move a little bit more into an accommodative or a neutral stance and start to be a little less restrictive. Initial jobless claims just tells us who got laid off, and it comes out every Thursday. We look at this, we can kind of see that jobless claims actually went down substantially. So we had a couple weeks ago that it looked like, things really went up substantially, and now they're kind of settling. So again, this is that fog and that little bit of mixed data that's giving the Fed a little bit of pause. Again, if we look at this in the last 5 years, which takes us back into COVID, you can see how far the economy has rebounded and really shows you the resilience of the economy. And the challenge with this is that most of the economy has been in an expansion mode. Housing has been one of the only segments of the economy that's been in a recession, and it's been a hard one. I've been through two recessions, through two housing recessions, and I'm not lying. This is probably the hardest one that we've been through. We're also positioned for some good growth. So it's unfortunate to say, but as some people lose their jobs, that probably means that housing will continue to accelerate. Builder confidence, this is an important one also. Builder confidence has been at all-time lows for several months in a row. So when we measure this, anything above 50, they say, hey, we feel good about the future. Anything below that, they go, we're not feeling so good. We're actually up this month 5 points at 37, the highest since April of 2025. And you can kind of see how this has started to move in the right direction. And you can see 2022, after everything just really came to a screeching halt in June of 2022, you can see how the confidence went up as they were selling their inventory off. And then, of course, it's dropped and waned. So builders are feeling more confident about 2026 with rates down, affordability up, and continued undersupply, which we're going to talk about in a minute, of single-family existing home inventory. They're still positioned to be able to offer great perks, great interest rates, and take advantage of that low market. So we've talked a little bit about Jerome Powell, so I'm going to touch on some existing home sales. Existing home sales, which are single-family existing home sales, they rose to 4.06 million. Now, it's interesting to note virtually never gone below 4 million. We've had a 3.9 million, but on average, there's about 4 million homes that transact in every single year. This was up 1.5% month over month, so that was a big jump. The one caveat, I told you there's an asterisk. The Amazon server debacle that happened this month when everything went down and everyone's banks and all that stuff. Yes, Leslie, that is national. That is the National Association of Home Builders survey that Wells Fargo takes. When AWS went down, there was an extra day's data that got collected in this. So we're watching that to see was that an anomaly, or were things really ticking up? But here's also an important thing. When you see all of the doom and gloomers on YouTube and TikTok and all these people that are telling you that prices are crashing, and by the way, even in Florida, I see prices are just crashing and it's terrible. The reality is that we've seen median prices increase over the US by 2.1% year over year, and it's the 27th consecutive month in a row of price increases. So we're still in a very healthy housing market, despite what some doomers and gloomers are saying. And those are people that just don't really pay attention to the data. So this shows that trend where you can see we finished 2025 or 2024 a little stronger. 2025 has been very muted, and we're starting to increase that trend. I would say we're probably going to see in that 4.2, maybe 4.3 million sales. And to contrast that, 2021 saw 6.3 million home sales. There was about 2 million more home sales. But the important thing to know on this is that for the last 3 consecutive years, we've had somewhere between about 1.2 and 1.7 million transactions that should have occurred that didn't. And if you do that math, that means we have an entire year's worth of transactions that did not happen, that should, could, and probably will happen eventually, which is why I say the next 3 years, we're setting ourselves up for a really, really good position. If you just look at this on a historical level, 10 years, you can see what happened during COVID and then the giant run up, and then things really kind of slowed down in that June 2022 timeframe. You can see that June 2022 timeframe, and then boom, it's been seasonal and cyclical since then. Now, I cover this every month because this has been the challenge that we've been living for the last 3 years. The average appreciation of new homes, and this is as of last month, was up 49% over a 5-year period of time. But in that same time frame, the amount of income, the average wage growth of a typical consuming household only increased by 17.5%. And that created this gap in affordability. Now, rates have come down. This chart has not been reposted yet. So this is based on last month's data. But when you look at 5 years ago, where the median home price was at the then existing interest rates compared to today, it was a 92% increase just in the principal and interest. So it was 92% more expensive to own a home, and it took a 52% increase in the income needed to qualify. This has just been that affordability issue that it's not so much that we have a rate lock-in effect, it's that we just have an affordability issue. It's just really hard for people to stomach the increase in affordability. And that's where that interest rate coming down and creating that extra 10% affordability that we were talking about early in the call, that's where it's making a difference. And so we should have some new numbers by next month for Q3. And if not, we'll just do the math by hand and bring that to you. So national housing, if we look at what's happening across the US, which gives us a sense of where do we stand as a housing economy? Right now in the US, we're still in slight seller advantage territory. There are still markets like Massachusetts, some of those northern areas where there's a severe shortage of inventory. There's other areas like Texas and Florida where there's a little bit of an over surplus, although that is starting to mitigate just a little bit. But on average, it's a seller's inventory, or it's a seller's market. Median list price in the US right now is $437,900. This is an interesting statistic because I want you to see what's happening in Florida, because this is going to be opposite. But the median list price of a new listing right now in the US is $399,000. So a little bit below the current inventory on the market. Average days on the market in the U.S. is 114. 42% of the U.S. has taken a price decrease this month. And there's about 10% that are getting relisted. There's an interesting statistic that I will show you on that. So if we compare last month to this month, you can see median list price is down overall. Median list price of new listings is also down. So that's an interesting trend. We also see the average number of days is up by 4. And in the US, there's currently 867,000 existing homes that are available for sale. This data comes from Altos data that tracks every home available in every market in the US every single day. So we're up about 1% over last month in inventory. So inventory is growing, and that's not unusual. When we get into the Q4, you start to see things slow down. It's cold. People don't make as many moves in the northern parts of the country. We look at the U.S. condo market. 375 is the current median in the U.S. The median price of a new listing is 369, so very similar. You're seeing people coming on the market, a little more competitive pricing. The average days on the market for a condo, 135. 36% of properties have taken a price decrease. That's very, very in line with the historical average of 34% in any market. So prices are still pretty stable. And there's 228,767 condos available. We're still in a little bit of seller territory. When we get in that 30-31 market action index, that's a pretty balanced market. It's not really, doesn't give the benefit to the buyer, it doesn't give the benefit to the seller, but it's a little on the seller side. We look at what's changed since last month in the condo inventory. We are down 1%. Actually, I take that back. It says down 1%. We're actually up 1%. So inventory nationally continues to climb just a little bit. This is what this looks like as a national housing supply. So we're currently 867,000 homes available. This number traditionally would be somewhere between about 1.2 and 1.4 million. That would be considered a stable, balanced, healthy market. So we do still have an undersupply of anywhere from, we're at about 60 to 70% of the historical numbers. If there's a silver lining that we've experienced in the last 3 years, it's this chart right here. Because in March of 2022, we had the historical low of 240,000 total homes for sale. Think about the entire US, the entire housing stock out there. There are only 240,000 homes available. That was a savagely unhealthy market, and that's what pushed the crazy frenzy. It's what pushed interest rates up. It's what pushed pricing up. It's what caused inflationary pressures, or a significant part of it. So we're in a much healthier position than we were back then. For lack of a better way to put it, this slowdown has allowed the market to recover, has allowed inventory to get to better levels. And because 8 out of 10 buyers bring a home to the market, as we see buyers re-enter the market in the year ahead, you will see that inventory continue to grow. And again, that's a very, very good thing. So when you see the doomers and the gloomers that say, oh, inventory's up 50%, it's not a bad thing. It's actually a good thing. Now, if we were to start to get over like 1.4, we get in the 1.6, 1.8 million range. Okay, now we might be having a little bit of an oversupply, and that would be a challenge. So if we look at the average days on the market trend, we're currently 113 nationally. That's up from that extraordinarily low 54 days in July of 2022. I talked a little bit about this. Long-term average on price decreases is 34% right now. US, 41% of all residential properties have taken a price decrease, and that's up from that 16.6% in 2022. This is one of the graphs that I thought was interesting. Nationally, the number of homes that are returning to the market that are taking a relist is actually growing. This is a statistic. Typically this time of the year, we would see this number going down. As we get closer to the holidays, we all know this. Our market is a little different here, so we have a little different seasonality. But as you start to get into that November, December timeframe, they go, I just want to take it off the market, have the holidays, I'll put it back on in January. So to see people starting to list in this late Q3, early Q4 timeframe is an indication that sellers are feeling good about where we're headed, and that's an important statistic to pay attention to. If we just look at the median list price, in the U.S., that luxury in the U.S. is really anything about $550,000 and up. The bottom quartile represents about a $220,000 price point. Then you've got $369,000, $550,000, and about 1.1. Now, one of the things that I will show you on a future slide how this changes with our local markets and a couple of trends to really watch that are positive for your sellers. So if we take a look down and bring this down to Florida, what's happening in our states? Overall, in the state, we're still in seller territory. So it is still advantage seller in terms of negotiation power. The median list price is $482,000. The median list price of a new listing this last week was $450,000. Average days on the market, 139, so a little bit less than the national average, interestingly. Price decreases, we are at 44%, so a little higher than nationally, and we have 8% relist, and you start to see that little trend that's also trending up. So we're trending up the same way locally or in Florida that we are at a national level. If we just compare this to last month, you can see that median list price is actually down just a little bit. However, median price of a new listing is up $450,000. This is a trend that is different than the national trend. You do have median days on the market of 98. The average days 139, and inventory month over month was flat. We didn't really see a big increase. If we take a look at the condo market in Florida, we see that median list prices continue to fall. We're sitting at 340, and that's an indication we just have a lot of competition. The Keystone inspections, the requirement for additional reserves, the 4 hurricanes that we've had the last couple of years have increased insurance prices. We're seeing a little bit of that start to settle in, and yet that's impacted the condo market disproportionately. We are a little bit in, this says it's actually buyer's advantage territory right now. So you've got a little bit of advantage buyer, a little bit better negotiating power. But I thought this was interesting. We're only at 34% of the market price decreasing. So that's a very healthy market at this point. That's a very typical historical number. If we compare this to last month, inventory is up 1% month over month. Median list price is flat. But again, the median price of a new listing is going up. So sellers that are coming to the market are feeling better about pricing high. Now, that could be agents that just aren't good at reading the market trends. And yet at a national level, they're reading the trends pretty closely. So we're going to watch that number because that's an interesting development. This is a new graph for us. So you guys haven't had an opportunity to see this before. This gives us a year over year pending timeline. So how many pendings happen by week compared to the last 4 years? In the black line here, you will see this is our 2025 number. We have 2024, 2023, and then 2022. You will notice we're in the fourth quarter and we see the pendings increasing. And even though we're a seasonal market, we have not seen that for the last several years. That's not been a trend. We are above the 2024 numbers, and we're starting to get a little bit, we're pacing towards being ahead of 23 and 22 numbers. That would be a good thing, and that would be an indication that the market's headed in the right direction. We look at local housing markets, just individual counties. Charlotte County, we'll start there. We're a little bit advantage seller territory. The median price of a new listing, 408, with the median list price of 405. So again, new listings coming to the market are a little bit higher than the existing inventory. That's an interesting trend to watch. Price decreases are at 41%. If we look at the condo market, the median list price of something on the market currently is $275. The median price of new listing, $352. Again, we see new listings pricing at a higher level than existing inventory. That's just a fascinating thing. So again, that's something that we're going to watch closely. Charlotte County is at a 30% number for price decreases for condos. So again, pretty healthy place, and we're starting to see that level off. But we are at 193 average days on the market for a condo. So we're 6 months plus to be able to get something sold in Charlotte County. And yet this is a little bit of again, this is one of our new charts that we have available this month. You'll see that in Charlotte County, the pendings that are happening right now are actually significantly above 22, 23, and 24 levels. So if you're listing or working with buyers in Charlotte County, things are progressing quickly, and this is some positive data. We just look at a couple key statistics. There's currently 2,774 homes that can be bought and closed on in a reasonably short period of time, and that's up from that terribly low number of 282 in 2021. We look at, let's see here, average days on the markets. We're sitting at 174, and you can see that trend is still going up substantially, and we're up from that low in 2022 of 39. Median list price continues to kind of trail downward, but we're at 405. And again, that doesn't mean prices are going down. It just means sellers got more realistic about the pricing that they were bringing to the market. In other words, things that may have been increasing at a 5 or 10 or 15% rate previously now may be increasing at a 1.1 or a 1.2% annual rate. Price decreases, you do start to see that coming down a little bit in Charlotte County. So we're at 40.8, and I believe we were at about 48% at the high points. Actually, we were over 50%. Now look at that. That looks like 54% of the high point. That's up from that 11% in 2022 when everything started. Price segments, I left this in here this month because it's in, if you just focus on your price points right here, there's an interesting trend that is emerging that has really started to show up, and that is this. When we look at price decreases by tranche, so the lower 25%, the second tier 25%, third tier, fourth tier, you'll see that the bottom tier, we see 50.5% of properties having taken a price reduction in the last 30 days. So 1 out of 2 versus the top end of the market where we're at 36%, which is typically pretty typical. So we go back to that, we're seeing that a $260,000 home in Charlotte County, 1 out of 2 of those are taking a price reduction. Now, there's still some softness in that pricing. The 350, it was over 40%, still pretty high. The 478, there still was some price softness, and then the top tier is holding a little bit steadier. So interesting to note, and I put an asterisk on that so that if you're using those in your listing presentations, you can pay attention to that. If we pop up to Sarasota County, we are in advantage seller territory, but only by a small margin. Again, 525 is the median list price. Median price of a new listing, 479. So that mirrors and matches what we're seeing at the national level. But the average number of days on the market, 150. So we're still up there a little bit. If we break this down into the condo market, you'll see those median list prices do actually continue to increase for the condos, 399. Again, median price of a new listing on a condo, 439 and rising. So new inventory coming to the market are feeling better about pricing going forward. Interesting statistic. 35% of condos have taken a price reduction. So that's in line with Charlotte County, where we're in the more healthy range. And if we look at Sarasota, again, this is a new graph this month. We look at pendings year over year. We're above 22, 23, and 24. We're actually accelerating into the fourth quarter. So if you see what happened the last 3 years, October, November, and December, it was kind of a downward slide. This is a return to a more seasonal, more typical market for us. And I believe that that's driven by a little bit of pent-up demand, which I don't love that term, but that's a little bit of demand that has not happened, and affordability, just a return to interest rates. So if we look at Sarasota, we have 3,249 homes for sale, which is up literally tenfold over the 328 that were available in 2022. Average days on the market, we're getting close to that 150 mark, up from that 37. So you're 4 to 5 months in terms of the average. Now remember, average is the best of the worst and the worst of the best. And we've got our money slide in here this month that's updated to show you what's happening if you price right versus if you don't price right. Median list price sitting 529. Sarasota County properties with price decreases, we're at 40% the last 7 days. So we're starting to get back into that healthier territory. People are getting realistic about pricing. Pricing that was on the market at too high of a price has started to adjust and has gotten realistic. But again, if we look at the tranches of the 4 quartiles here, and we look at that bottom quartile being an average of 319, the next quartile is 445, the next is 650, which means your luxury market is really basically 700 and above, 750 and above. When we look at price reductions by quartile, your bottom 3 quartiles are significantly are taking a disproportionate amount of the price reductions. So again, all 3 of those price points, 1 out of 2 homes has taken a price reduction in the last the last week. The last 30 days. So that's a pretty significant number. So when you're looking at that, anywhere in that 300 to 700 price points, there's still some softness in that market that's showing up. If we pop up to Manatee County, we're still in seller advantage in Manatee County. Median list price $569. Once again, we see the median price of a new listing substantially above the existing price. Now, if those are new constructions that are actively available, in other words, they didn't list them until it was substantially built, that could impact that number. But if it was new construction that's out of ways, they stripped that out of this data. So again, that's telling a picture that sellers are feeling a little more comfortable pricing at a higher pace headed into season. If we look at this in terms of the condo markets, Manatee County still pretty flat at $299 median list price. Once again, median price of a new listing, $337, same trend, so opposite the national trend. Average days on the market, 157. 42% have taken a price decrease. Manatee County paints a little different picture. We are still seeing pendings above last year, so we're better than last year, and yet we're still below 2022 and 2023 levels. So just an interesting number to continue to watch. And, that could be reflective of the amount of new construction that Manatee County has, because a lot of Lakewood Ranch is Manatee County. Yeah, we'll watch that very closely. Inventory currently is 1,210 homes for sale, so significantly less than the other 2 counties, up from that low of 268 in 2022. We have average days on the market, 157 currently, so about 5 months-ish time to sell a home. And our median list price, $299, down from $857 in 2022. When we look at price decreases, we're sitting at about 42%. So 4 out of 10 have taken a price reduction last month. Not as high as some of the other counties, and starting to return to a little bit more of that typical number. But once again, I show the price tranches here. Manatee County, the lowest quartile is 159. Then it's 259, 350, and 550. And if we look at that, we also see that bottom quartile still a lot of price reductions, 48.3%. So that's still probably reflecting the fact that affordability was harder on a first-time buyer this last little period, and therefore there's more likelihood that those are taking price reductions to get out of the market. So here is your money slide, and this is, I know, Wayne Diller's favorite slide. I did have some updated data this month. So I took a look at all of the listings that have sold in this last period where the seller and the agent decided to actually get the price priced correctly at the first attempt, and how long it took to sell versus how long it took to sell if they mispriced it, and then what was the average list to sales price. So if a seller is listing their house and they're paying attention to the market across our Tri-County area, the average days on the market of a well-priced, well-positioned home is currently 28 days. And when you see all those numbers that were 140 and 150 and 180 days, 28 days, that's a low number of days on the markets. Homes were selling for an average of 95.3% of the original price. So your conversation with your seller is, hey, if we price this right, we would expect to get an offer in roughly a month-ish, and we would expect to get about 95% of our list price on average. If you overprice and you take one or more price reductions, on average now it's taking 134 days. That number you'll notice has continued to kind of increase. 134 days, and it's selling for 84.8% of original price. When we did the math last month, what we calculated was it was about a 10% less. In other words, the sellers were losing about 10% of their negotiated value versus those that priced well. So you actually get an advantage by pricing the home right. It sells faster, and you actually get more money for your home as it relates to your list price. So this is something that I would put in every one of your listing presentations, because it's really, as Wayne calls it, the money slide. And so let's just kind of land the plane and give you some talking points. What does this all mean? Well, we're in a good market right now. We're certainly in a better spot than we were at the beginning of the year. Rates are down. We have a little bit better handle on inflation. We're a little bit unsure about where the job market's headed. So we've got some question marks in that. And yet the next probably 3 to 6 months are going to look like things will continue to improve. So for a buyer, this is a script you can kind of internalize. We're finally seeing some positive movement. Rates have started to ease, and that means for a buyer, your affordability has improved. The roughly 1% drop in rates gives you 10% more purchasing power, which is like getting a $50,000 upgrade on a $450,000 home without spending $1 more each month. The important thing to note is that as rates continue to go down, more buyers will enter the market, and that will increase competition. So getting ahead of that wave now means more negotiating leverage while inventory is still tight. So this is a way that you can position a conversation with your buyers. And it's not just a talk track. It really is a true reality that probably as those rates hit that 5 3/4 or anything sub 6, you'll see buyers coming back in, and you'll see more multiple offer negotiations than we saw earlier this year. For a seller, this says buyer, but this is actually for a seller. With rates coming down, we're already seeing affordability improve and activity picking up. So as rates drop, hundreds of new buyers are re-entering the market. And buyers who could not afford your home last January, they now can. That creates more showing, stronger offers, and potentially shorter market times. So if you're waiting for the right time to list, this is the window where affordability is improved and pricing remains strong. Positioning your home on the market now will help you capture that first wave of returning demand at a great price if you're purchasing up again. So again, for a seller that's selling and buying, when prices start to accelerate, they're also going to pay a higher price on the buy side. And that is unless they're moving to a market that just is bucking the trends. So with that said, I'm going to ask for any questions or any ahas and just close out by saying this is a time to get really close to your database. It's a great opportunity to make the care calls to your database, your centers of influence. Make sure that you're reaching out, staying in close proximity, because there will be people who have been on the sidelines who, for the last 2 or 3 years, they didn't have a need. They may have had a want, but they didn't have an immediate pressing need to move. And with rates coming down and affordability improving, they will be coming off the sideline. My goal for you is that they work with you and not one of your competitors. So this is the time to be able to close that gap. The rate movement down also creates an opportunity just for a care call, that if you're doing an equity checkup, which gives an idea of how much, it's really a CMA in reverse. It's how much equity do they have, and does a refinance maybe fit the bill and actually reduce their rate? So if they bought the last couple of years, particularly if they were one of your clients, they may qualify for a lower rate that would save them a couple $100 a month. So stay close to your database. There's one question in the chat. The question from Diane: in 2026, if interest rates do as we expect and inventory increases, how can we use this to help guide our home listing prices, and how much increase in prices would we expect? It's a great question. We're expecting to see prices in Florida probably up 1 to 3% over the next 12 months. again, you see a tremendous amount of gloom and doomers out there. I see the posts, I see the YouTubers. There are some of the people right here in Sarasota, agents that we know that are posting about the impending price crash and things are down. The reality is that's not the case. Balance sheets in homeowner balance sheets, or the amount of equity they have, are the best in US history. So homeowners have never had more equity. Now, we do have some leading indicators. I'm working on getting some data on this. We do have some leading indicators that foreclosures are on the rise. And I know that there is a short sale class that's being offered by our broker this next month as a result of that. So for those of you who are around in the 2008 through 2011, we did a lot of short sales. Those were people that did not have equity, that lost their jobs, got behind in their payments, and had to sell for less than the equity that they had in their house. And they're tricky transactions. And yet, as a professional, when you can help a seller in that position, you will earn their trust for life. Trust me on that. So that's a great class to attend. But as it relates to next year, it's always a matter of looking at what is currently on the market, what are we competing with, how long has it been sitting there, what's sold, what new listings are we competing with, and then just making that professional assessment of where do we fit in that price point. And I think the important thing to remember with sellers and remind them is that's not a once and done process. That's an iterative process that we're looking back every single week to say, hey, we priced based on what happened, a week ago, back to maybe 6 months ago. Now, what new inventory has come on the market and how does that change our perception of where we need to be in valuation? What went pending and how does that change our perception of value? And what sold? What did buyers actually put a price on and how does that change our opinion of value? And that process really happens weekly. And then when we talk about the listing life cycle, really it's about every 30 days or 5 to 8 showings that the market is telling us we're overpriced. And I always say the market's always talking to us. The question is, are we listening? And our job as agents is to pay very close attention to what's happening in the market and be able to interpret that data, which is part of the purpose of this entire call, but also why being able to pay very close attention to the micro trends in the individual neighborhoods, the individual markets. So really drilling down to get a sense of what's happening. Are things selling higher? Are they selling lower? Are they trending up? Are they trending down? But by being the local economist of choice and just knowing these numbers and having perspective on history, that does give you a better perspective that as things change, you can start to anticipate where are things going to go. So hope that answers your question. Any other questions for the good of the cause? Let me double check in the chat. I think that was the last one. All right. Well, guys, I want to thank you for spending your time. I'm a few minutes long, so I apologize. We just had a lot to cover today. Thank you for being here. Thank you for your commitment to your business. And go take this data, update your listing presentations, update your talk tracks with your customers. And Diane, I will send out a recording of this along with the slide deck, and I'm going to send out a bonus script. We talked about this in the AI Success Series. If you've not been attending that, it's a fantastic class. It will teach you how to use AI in your business to make more progress faster. But I'll send out a script that you can use to record a video and create some viral moments with your database and with your social media. So thank you all. We appreciate it. Go have a great rest of the day and a great weekend. Cheers.